Welcome to our comprehensive guide on Hong Kong's foreign-sourced income exemption regime. In this video, we'll explore the recent FAQs released by the Inland Revenue Department and their implications for businesses in Hong Kong. The FSIE regime is central to Hong Kong's tax policy, offering exemptions on certain foreign-sourced income. However, to benefit from these exemptions, businesses must navigate complex requirements. The IRD's latest FAQs provide much-needed clarity on several aspects of this regime. FAQ 9 Covered Income. FAQ 9 addresses what happens when specified foreign-sourced income, FSI, is used to purchase overseas property. Even if the property is later sold, the original FSI remains taxable when remitted to Hong Kong, provided it meets the FSIE conditions. This mirrors similar treatments in other jurisdictions, like Singapore. FAQ 25 Economic Substance Requirement for Contingent Gains. Moving on to FAQ 25, it clarifies the economic substance, S, requirement for contingent gains from the disposal of equity interests. If these gains accrue after January 1, 2023, they fall within the FSIE regime's scope, regardless of when the disposal occurred. Importantly, the year of assessment in which these gains are recognized will determine the ES requirement compliance. FAQ 26 Debt and Equity Interests. FAQ 26 provides guidance on entities holding both debt and equity interests. Even if an entity disposes of all its debts before the year end, it's not considered a pure equity holding entity for that year. This distinction is crucial for businesses to correctly assess their tax obligations. FAQ 28 Participation Requirement and Indirect Transfers. FAQ 28 explains that corporate income tax, CIT, charged by a foreign jurisdiction on an indirect transfer of a subsidiary is taken into account for the FSIE regime's subject to tax condition. If the foreign tax rate exceeds 15%, this condition is met, potentially simplifying tax compliance for multinational enterprises. FAQ 29 Tax Exemptions Under Participation Regimes. FAQ 29 presents a challenge for businesses involved in equity disposals. If the gains are tax-exempt under a participation exemption regime in a foreign jurisdiction, the subject to tax condition isn't met, resulting in no FSIE exemption in Hong Kong. This could impact businesses operating in Europe, where such tax exemptions are common. FAQ 30 Apportionment Approach and FSIE. Lastly, FAQ 30 discusses the apportionment approach. If foreign-sourced dividends are derived from a mix of taxable and tax-exempt profits, the FSIE regime doesn't allow for apportioning these profits. In other words, unless the entire underlying profit meets the subject to tax condition, no part of the dividends qualifies for exemption. This is an area where further legislative refinement is required. Understanding these FAQs is critical for optimizing your tax position under the FSIE regime. For tailored advice, reach out to our experts or visit our website. Thank you for watching and staying informed on these essential updates.